Ever wonder how we can possibly trust the numbers that a huge company reports? Well, it's not magic. It's actually a system. Today, we're going to decode the golden rules of accounting. These are the principles that turn all that chaotic business activity into a story that's clear and trustworthy. Think of it as the secret language that our entire economy is built on. So let's dive in. So really, ask yourself this. When a company claims it made, say, $1 billion, how do you really know what that means? How can you be sure they aren't just, pulling numbers out of thin air? And is their profit this year really comparable to last year or to their biggest rival? Getting the answer to that is absolutely key to all modern business. And that key, well, it's a shared set of rules. It's like the grammar for the language of business. These principles are the absolute bedrock of trust. They make sure that when a company talks about its money, its assets, its debts, we all know exactly what they're talking about. Without them, things like investing or lending would be a total shot in the dark.
To make all this real, let's follow a story. I want you to meet Andrea. She's an entrepreneur, and she has just kicked off her very own business. We're going to follow her journey right from day one, and it's going to be our guide through all these essential ideas.
Okay, so before Andrea even makes her first sale, we have to define the playing field. What is her business, and what is just, well, her? This is where our first two foundational principles come into play. They basically create the container for everything else that's about to happen.
We're going to start with two big ideas, the business entity principle and the going concern assumption. These two really set the stage for all the accounting that follows.
First up, the business entity principle. And this one is so important. For accounting purposes, the business is a totally separate thing from its owner. So Andrea's personal car, her personal home loan, that's all on her. The company's inventory, its bank account, that belongs strictly to the business. We have to draw that line because we're trying to tell the financial story of the business, not the story of Andrea the person.
Next up, we've got the going concern principle. This one is all about making a really critical assumption. We prepare all the financial records as if Andrea's business is going to be around for a long, long time. We assume it is not about to go bust tomorrow. And that's what lets us make long-term plans and create a financial story that actually has a future, not just a past.
Okay, so Andrea's business is officially its own entity, and we're assuming it's going to stick around. Now the action starts. She's buying things, maybe selling things. So how do we capture all of this activity in a way that's accurate and, most importantly, balanced?
So let's take a simple, really classic transaction. Andrea buys some goods that she's planning to sell later. She buys them from a supplier, let's call him Brian, and he agrees that she can pay him back later. Now this single event, it's going to create a ripple effect through her financial records.
And this brings us to one of the most fundamental principles in all of accounting, duality. You might know it as double-entry bookkeeping. It all hinges on this simple but really powerful idea. Every single transaction has a dual aspect. Just picture a scale. For every action you take, there has to be an equal and opposite reaction to keep those books perfectly, and I mean perfectly, in balance.
So for Andrea, here's how that dual aspect looks. On one hand, she receives goods, which increases her business's assets. But at the exact same time, she now has a responsibility to pay Brian back later, which increases her liabilities. To record this, we make two entries, a debit to her purchases account and a credit to trade payables. See? The financial scale stays perfectly balanced.
Now, I know debit and credit can be confusing. They trip a lot of people up. But here is a fantastic little memory trick for you. Just remember the word AID, A-I-D. It stands for an asset increase is a debit. Seriously, if you can just remember that one rule, everything else just follows logically. An asset decrease, that must be a credit. A liability increase, a credit. And a liability decrease has to be a debit. It's a really beautiful logical system.
So what dollar value do we actually use? Let's say the goods Andrea bought from Brian cost $500. The historical cost principle says we record them at $500, period. Even if their market value jumps up to $600 tomorrow, we stick with that original price. Why? Because it gives us an objective, verifiable number. It anchors the financial records in solid fact, not just someone's subjective opinion.
Right, so we've defined the business, we've recorded our first transaction. Now we get to the real philosophy of reporting.
This next set of principles is less about the mechanics and more about making sure the final story we tell with the numbers is fair, consistent, and actually useful to someone.
And to do that, we're going to look at 4 guardians of honest reporting: accrual accounting, materiality, consistency, and prudence. First off, accrual accounting. And listen, this one is a big deal. It basically says that we record transactions when the economic event happens, not necessarily when the cash changes hands. Why does that matter so much? Because it gives a much truer picture of how a company actually performed in a specific period of time. Let's apply this to Andrea's purchase. She got the goods on January 25th. That's the real economic event. So under the accrual principle, she records that purchase and the liability right then and there in January. The fact that she doesn't actually hand over the cash until March 25th, that's a completely separate event, and it gets recorded in March. This system prevents companies from messing with their performance just by, delaying or speeding up payments.
Next up is materiality. Honestly, this is all about common sense. Accounting isn't about tracking every single penny with insane precision for reports that go outside the company. The real test is this. Would leaving out this piece of information or getting it wrong cause someone, like an investor, to make a different decision? So rounding your revenue to the nearest $1,000? Probably not material. Hiding a massive lawsuit that could sink the entire company? Oh yeah, that is absolutely a material omission.
And how do we make sure those decisions are based on solid comparisons? That's where consistency comes in. This principle demands that Andrea uses the same accounting methods year after year after year. It means we can confidently compare her performance in 2024 to how she did in 2023. And it also helps us compare Andrea's business to her competitors, because ideally, everyone is playing by the same consistent rules.
And finally, we have prudence. Look, business is full of uncertainty. When accountants have to make estimates or judgments, the principle of prudence tells them to be cautious. It means you don't go around overstating your assets or your income, and you definitely don't understate your liabilities. But it is a balanced caution. You shouldn't be overly pessimistic either, because that would be misleading too. It's all about presenting a realistic, sober picture. So wow, we've covered a lot of ground, from the business entity concept all the way to prudence. But why does this whole web of rules matter so much? Let's bring it all home. When you put them all together, these principles build a system of trust. Because we know everyone is using the same shared logical framework. They create comparability, which lets us measure performance over time and against other companies. And ultimately, all of this enables sound decisions by investors, by lenders, and by managers like Andrea. This whole system, it's the engine of a healthy economy. So, the next time you look at a financial report, just remember, it's not just a page of numbers. It is a story. And it's a story told using a very carefully constructed language. These principles aren't just dry rules for bookkeepers. They are the absolute foundation of trust in modern commerce. And that leaves us with a really fascinating question. What would our world even look like without them?